Hi there, I had to start buying stocks today from scratch. Knowing what I know about this AI market, this weird May setup, and the way money keeps rotating underneath the surface, I would not just run into whatever has already gone vertical. Most people think investing is about finding the loudest chart, the hottest ticker, the thing everybody on the internet is suddenly screaming about. But that is usually not where the best risk reward is. That is where the crowd gets comfortable before the market turns. What happens next? Because that is the whole game here. Not what already doubled. Not what already had the perfect month. Not what every fund manager already chased for AI exposure. The real question is, where is the market mispricing the next move? And today, Sunday, May 3rd, New York time, I want you to comment what day and date you are watching from, because May is not just another page on the calendar this year. It is coming after a huge rebound and a market that still cannot decide whether it is scared of AI or addicted to it. Also, if you value this kind of original market breakdown, support the channel by subscribing and comment John AG Best below. It tells me you want more straight thinking and less recycled market noise. So in this video, I'm going to walk you through 5 stocks I would be looking at right now, not because they are all the same, they are not. We have a growth platform, a copper giant, a cybersecurity name, an income real estate play, and one space stock where I would think about the entry very differently. And by the end, you will see why the best move in May might not be chasing yesterday's winners. Now, first, understand the backdrop. The market just had one of those runs that changes sentiment fast. Based on recent market updates, the S&P 500 and NASDAQ both finished April with their strongest monthly performance in years, and AI powered much of the rally. When a market flips from fear to confidence that quickly, investors forget risk. They do it every time. A few red weeks, everybody wants cash. A few green weeks, everybody suddenly becomes a long-term visionary. And right in the middle of that emotional swing, we walk into the old Wall Street phrase, sell in May and go away. Now, I do not treat that saying like some sacred law. It is not. Historical data shows the May through October stretch has often been weaker than November through April, but weaker does not mean automatically negative. And this is where people get lazy. They hear a phrase, build a strategy around it, and wonder why the market ignored the bumper sticker. So the question is not, should we blindly sell in May? The question is, after a huge AI-led rebound, where do we want to be selective? That is why I do not want to just talk about the obvious winners. Some storage names, chip names, and AI infrastructure names have already gone absolutely crazy this year. Congratulations to everyone who owned them. But when a stock gives years of returns in months, easy money may be behind you. And that brings us to stock number 1, Spotify. Spotify is interesting because the old bear case was very simple. Great product, not enough profit. Everybody knew the app. Everybody used the app. But investors kept asking whether the company could actually turn attention, subscribers, and listening hours into a serious profit engine. That story has changed. According to the latest publicly available numbers, Spotify now has more than 750 million monthly users and close to 300 million paying subscribers. Revenue is still growing, gross margins have improved, and operating income recently reached roughly 700 million euros that quarter. That is not some tiny side note. That is a company maturing right in front of investors. But the stock still got hit. Why? Because the market is worried about slower growth, higher spending, and AI music. AI-generated songs, fake artists, voice cloning, impersonation, all of it has made investors nervous. And honestly, some of that fear is reasonable. If synthetic content floods a music platform, it creates legal problems, trust problems, artist problems, and brand problems. But here's the part I think people miss. AI music is not Spotify's problem. It is the entire music industry's problem. The artists care, the labels care, the platforms care, the lawyers definitely care, because lawyers always find a way to care. So when the threat is that broad, the largest platforms do not usually disappear. They become part of the enforcement layer. Spotify is already removing fake content at massive scale, and at the same time, it is using AI for product features, personalization, playlist discovery, and advertising. That means AI is not just a threat sitting outside the gate. It can also become a tool inside the business. So I do not look at Spotify and say, oh, this is perfect. It is not perfect. Growth is not as explosive as before. Spending is going up. Expectations still matter. But if the market has punished it like AI is only a destroyer, while the business keeps showing scale, pricing power, and improving profitability, that gets interesting. Not perfect, just interesting. Stock number 2 is Freeport-McMoRan. And this is where the AI story gets physical. People love talking about artificial intelligence like it lives in the air. It does not. It lives in data centers, power lines, cooling systems, substations, transformers, and server farms. It lives inside an electric grid that was not designed for this level of load. And that takes copper, a lot of copper. Freeport is one of the biggest public ways to get exposure to that. It is not a clean little software company with 90% gross margins and a cute investor deck. It is mining. It is messy. It is cyclical. It is exposed to operations, commodities, countries, permits, weather, politics, and all the things spreadsheet people like to pretend do not exist. But that is also why it can work. The latest company results showed copper and gold sales came in better than earlier expectations, and Freeport also began a phased ramp-up at its Grasberg underground operation in March, while adjusting the schedule because of material handling changes. In plain English, the company is still dealing with real operational complexity, but the resource base matters, and copper pricing remains strong. Copper recently traded close to $6 a pound. That matters because every extra bit in copper pricing can flow through to cash generation when the company is operating well. But let me be fair here. This is not a one-way trade. If copper prices fall, Freeport gets hurt. If global growth slows, Freeport gets hurt. If the AI build-out pauses, the commodity enthusiasm can cool fast. That is the counterpoint. The bull case is copper demand. The bear case is cyclicality. And both can be true at the same time. But if you believe AI infrastructure is moving from press releases into real construction, then owning some exposure to the materials behind that build-out makes sense. Not everything in the AI economy has to have a chatbot attached to it. Sometimes the most important AI stock is a mine. Stock number 3 is Zscaler. Now this one is interesting because the market has been doing that thing again, where it sees a new AI tool and starts selling entire industries like they are about to vanish by lunch. It is lazy thinking. It happened with search. It happened with software. It happened with service companies. And now it is happening with parts of cybersecurity. But cybersecurity is not optional. A company can delay a hiring plan. It can delay a new office. It can cut marketing. It can slow travel. It cannot just decide, you know what? We are done protecting our users, devices, applications, identities, and data. That is not a budget decision. That is how you end up on the front page for all the wrong reasons. Zscaler sits in cloud security and zero trust, which basically means the system does not automatically trust a user or device just because it shows up inside the network. It verifies. It controls access. It protects traffic. It assumes risk is everywhere. And in a world of AI-generated attacks, remote work, cloud apps, identity theft, and machine speed phishing, that model does not become less important. It becomes more important. Based on recently published numbers, Zscaler's latest fiscal quarter showed revenue growth in the mid-20s and annual recurring revenue above $3 billion. That is not a broken company. That is a company still growing at a serious pace. Now, does that mean the stock cannot fall? Of course not. Valuation matters. Competition matters. Customer spending cycles matter. And when high-growth software stocks disappoint even a little, the market can punish them brutally. But I think the market sometimes confuses a narrow tool with a full security platform. Code scanning is useful. AI security assistants are useful. They do not replace secure access, identity controls, data protection, policy enforcement, threat prevention, and all the boring plumbing enterprises actually need. That is why Zscaler makes the list. Not because the chart is pretty. The chart has been punched in the face. It is here because fear may have moved faster than fundamentals. And when fear moves faster than fundamentals, you at least have to look. Stock number 4 is VICI Properties. This is the boring one, which is why I like it after growth, copper, and cybersecurity. Because not every investment has to feel like a roller coaster with a ticker symbol. Sometimes the useful asset is the one that quietly pays you while everyone else argues about who has the best AI model. VICI is a real estate investment trust. It owns major experiential real estate, especially casino and resort properties, with long leases and built-in rent escalators. So instead of asking whether someone streams more songs or buys more chips, you are asking whether high-quality tenants keep paying rent on irreplaceable properties. That is a different bet. And with REITs, you cannot analyze them like normal companies. Earnings per share can get distorted by depreciation because real estate accounting does not always match cash economics. You look at funds from operations, adjusted funds from operations, rent coverage, debt costs, lease structure, and dividend safety. According to the latest company update, VICI grew quarterly revenue in the low single digits and adjusted funds from operations per share in the mid-single digits, while continuing to pay a quarterly dividend. That is not flashy. But flashy is not the point. Real estate has been hated because rates went up and income assets got repriced. When investors can get decent yields from safer places, REITs have to compete harder. That is real. But if rates stabilize or drift lower, the market may start looking again at durable REITs with long leases and predictable cash flow. VICI is not risk-free. Tenant concentration matters. Gaming exposure matters. Debt markets matter. A recession could hurt travel and entertainment. But the company owns assets operators really do not want to lose, and investors are getting paid while they wait. Sometimes cheap is cheap for a reason, and sometimes cheap is cheap because nobody wants boring yet. Stock number 5 is Rocket Lab, and this is where I want to be very careful. I like the long-term space infrastructure theme. I like the idea that launch, satellites, defense systems, communications, and orbital services become more important over time. But liking a theme and liking a stock price are not the same thing. Please do not confuse those. Rocket Lab ended last year with a record backlog of roughly $1.85 billion, up sharply from the year before, and it has continued announcing launches and space systems updates. The company is not just a launch story anymore. It is trying to become more of a full space infrastructure business. That is exciting. It is also dangerous if you overpay. The stock has already had a massive move, and when a high-risk growth stock runs that hard, I would rather be patient than heroic. If the stock pulls back toward a level where you would actually want to own it, then you can think about the entry. But buying just because the space economy is exciting is not a process. That is emotion wearing a space helmet. One way to approach it, if you understand options, is selling a put near the price where you would be happy to own shares. You collect premium if the stock stays above that level. If it falls, you may be obligated to buy. That can be a disciplined strategy, but it is not free money. Nothing in options is free money. If the stock crashes through your strike, you own the downside. So only use that strategy if you have the cash, understand assignment, and actually want the shares. So let us bring this together. Spotify is the growth recovery story where AI fear may be too dramatic. Freeport is the copper story tied to the physical side of AI. Zscaler is the cybersecurity story where panic may be confusing tools with platforms. VICI is the income story where real estate pessimism may be giving patient investors a better entry. Rocket Lab is the space story, but only with discipline, because a great future can still punish a bad price. Different angles. Same mission. Do not position only for what already happened. Position for what could happen next, while admitting that you could be wrong. That is the part most investors do not like. They want certainty. They want 5 stocks that go up immediately. They want the market to reward them for being excited. But the market does not pay you for excitement. It pays you for judgment, patience, and risk management. If you're successful, share your success story in the comments so others can stay motivated. And tell me which of these 5 you would buy first, which one you would avoid completely, and which one you think I am being too cautious on. Because I will tell you, the riskiest stock is not always the wildest one. Sometimes the riskiest thing is buying the safest sounding idea after everybody already agrees. So stay selective, keep some humility. Do not chase every green candle. Do not panic at every red one. Build your watch list. Know your price, know your risk, and let the market come to you. And remember, this is just my perspective for education and research. It is not financial advice. It is not a personal recommendation. And it is not a reason to buy anything without doing your own homework, checking your own risk, and making sure the decision actually fits your life.